On January 30th, 2026, Illinois regulators closed Metropolitan Capital Bank and Trust. Total assets, $261 million. Total deposits, $212 million. The FDIC confirmed it was the first bank failure of the year with an estimated $19.7 million loss to the Deposit Insurance Fund. And on the same day the bank closed, global financial markets experienced violent selling. Gold and silver recorded some of their steepest daily declines in decades. Bitcoin fell approximately 8%, and multiple financial outlets described the market action as resembling forced selling rather than a normal correction, with waves of margin calls cascading across asset classes. The bank failure itself was routine. Small bank, orderly resolution, depositors protected. But the timing mattered because it occurred during a moment of widespread liquidity stress. And that is the sentence I need you to hold on to for the rest of this video. Liquidity stress. Because what is about to hit American bank accounts this summer is not a single dramatic event like the collapse of Silicon Valley Bank in 2023. It is a convergence of 5 forces that are quietly, simultaneously, and relentlessly draining the financial security of every American who has a savings account, a checking account, a retirement account, or a credit card. And most people will not realize what is happening until they look at their bank statement in August and discover that the number they thought was protecting them has been eroded from 5 directions at once. And that is what this video is about. Not a prediction of a banking collapse. A documentation of the mechanisms that are destroying your financial security right now inside the banking system you trust with your money while the banks themselves post record profits. Your savings account is losing money every day, and your bank is making billions from the difference. Chase, Bank of America, and Wells Fargo pay 0.01% APY on standard savings accounts. If you have $10,000 in a Chase savings account for an entire year, you earn $1. $1. Meanwhile, inflation is running at 2.7%, which means that same $10,000 lost $270 of purchasing power. Your bank paid you $1. Inflation took $270. You lost $269 on $10,000 in a single year, and the bank took your $10,000 deposit and lent it out at 6.5% for a mortgage, 8% for an auto loan, 22.76% for a credit card. They earned between $650 and $2,276 on your money while paying you $1 for the privilege of using it. And the 4 largest banks in America reported combined profits exceeding $100 billion in the past year. JP Morgan Chase alone earned approximately $58 billion, and a significant portion of that profit came from the spread between what they pay depositors and what they earn on loans funded by those deposits. That spread, 22.75 percentage points on the credit card end, is the most profitable margin in the history of consumer banking, and it is extracted from the people who can least afford it. And high-yield savings accounts at online banks are paying around 4% APY, which is 400 times the rate offered by the big banks. On $10,000 over 2 years, that is approximately $897 more than a standard big bank account. And JP Morgan Chase's own Institute of Financial Health and Wealth Creation found that after accounting for inflation, savings and checking balances have been stagnant for nearly 2 years. For high-income households, balances are actually shrinking because the wealthy are moving their money to higher-yield alternatives. The people who have the most financial knowledge are fleeing the accounts that the rest of America is sitting in. They know the math. They are not willing to lose, and every day you leave your money in a big bank savings account at 0.01%, you are making a decision to lose purchasing power. You may not feel it because the number on the screen has not gone down, but the value of what that number can buy has been shrinking every single day for 6 years, and it is about to get worse because the new Fed chair is under political pressure to cut rates further, which will push high-yield account rates down from 4% toward 3 or 3.5%. And if inflation stays elevated because of the war and the food crisis, even the high-yield accounts could fall below the rate of inflation, which means there will be no safe savings vehicle in America that preserves purchasing power. Every saved dollar will be a depreciating asset. That has never happened in the modern era for this sustained period, and your bank will not tell you about it because the status quo is the most profitable arrangement they have ever had. The commercial real estate time bomb is sitting on the balance sheets of nearly 2,000 American banks, and the fuse is lit. Florida Atlantic University published an update on its U.S. banks' exposure to risk from commercial real estate screener, and what they found should concern every depositor in America. Among the 10 largest U.S. banks, 7 have total commercial real estate exposures greater than 50% of their total equity capital. U.S. Bank has 77%, and many banks with total assets between $50 billion and $100 billion have CRE exposure ranging from 350 to 500% of their equity. And Safer Banking Research warned that nearly 2,000 U.S. banks are at risk of failure between 2026 and 2027 because of commercial real estate exposure combined with unrealized losses on their securities portfolios. And the New York Federal Reserve explicitly stated that U.S. banks are extending their impaired CRE mortgages to avoid writing off their capital, leading to credit misallocation and a buildup of financial fragility. They are using a strategy called extend and pretend. A commercial real estate loan that is due for repayment but the borrower cannot repay gets extended. The loan is technically restructured, but the loss is not recognized on the bank's balance sheet. And the bank reports healthy capital levels to regulators while sitting on loans that the Fed itself has called impaired. And this strategy works only as long as 2 conditions hold. First, the commercial property values have to recover enough that the borrower can eventually repay or refinance. And second, the bank's other income has to be sufficient to absorb the losses if and when they are eventually recognized. And neither of those conditions is holding. Commercial property values, especially for office buildings, have declined 30 to 40% from their peak because remote work has permanently reduced demand for office space. The vacancy rate in major cities is at historic highs, and the $1.5 trillion in commercial real estate loans that are maturing between 2024 and 2027 represents what the industry calls a maturity wall. That wall peaked in late 2025 and extends through 2027. And every loan that hits the wall has to be either repaid, refinanced at rates that are double what they were when the loan was originated, or extended again with the loss deferred further. And the Claris Group's analysis suggests that 282 banks are vulnerable due to the combination of commercial real estate loans and interest rate losses. And the FDIC currently has 63 banks on its problem bank list. And the FDIC's Deposit Insurance Fund took a $19.7 million hit from the Metropolitan Capital Bank failure alone. What happens when multiple regional banks fail in close succession because the CRE maturity wall forces them to recognize losses they have been deferring for 3 years? The Deposit Insurance Fund will be strained, and your deposits above $250,000 are not insured. And the $250,000 cap has not been adjusted since 2010, despite cumulative inflation of over 40%. And the Senate Banking Committee held its first hearing on the deposit insurance cap since the 2023 bank failures, but no action has been taken. Your money above $250,000 at a single institution is uninsured. And the institutions holding it are sitting on impaired commercial real estate loans that the Federal Reserve itself has described as a buildup of financial fragility. That is what is on the other side of your bank statement. And your bank is not going to tell you about it. And I want you to understand what extend and pretend actually means in practice, because the phrase sounds clinical and abstract, but the reality is neither. When a bank has a $50 million loan to an office building that is now worth $32 million, the bank has 2 options. It can recognize the loss, write down the loan to $32 million, and report to regulators that it has $18 million less in capital than it previously claimed. That honest accounting would force the bank to raise capital, reduce lending, or in extreme cases close its doors. Or it can extend the loan, giving the borrower another 2 or 3 years to repay, and pretend that the loan is still worth $50 million on its balance sheet. The second option keeps the bank open, keeps the balance sheet looking healthy, keeps the regulators satisfied, and keeps your deposits flowing in because you have no idea that the bank is carrying $18 million in losses it has not recognized. And the New York Fed is not speculating that this is happening. They documented it. They said it explicitly. Banks are extending impaired mortgages to avoid writing off capital, and the result is a buildup of financial fragility. That is the Federal Reserve of New York telling you that the banking system is building fragility by deferring the recognition of losses that already exist. And the maturity wall, the $1.5 trillion in CRE loans that must be repaid, refinanced, or extended between 2024 and 2027, is the mechanism that forces the recognition, because you can only extend a loan so many times before the auditors, the regulators, or the market forces the issue. And when the issue is forced on hundreds of banks simultaneously, because the maturity wall is concentrated in a 2 to 3 year window, the recognition of losses that have been deferred for years happens in a compressed period. And that compressed recognition is what produces bank failures. Not a sudden crisis. A slow accumulation of deferred honesty that reaches its limit. And the first bank failure of 2026 has already occurred, and the warning from Safer Banking Research that nearly 2,000 banks are at risk between 2026 and 2027 is based on the intersection of that maturity wall with the unrealized losses that still remain on bank balance sheets from the interest rate surge. Credit card debt has become a national emergency that is destroying household wealth faster than any bank failure ever could. Americans are carrying over $1.21 trillion in credit card debt at an average interest rate of 22.76%. Total household debt has reached $18.8 trillion with 4.8% in delinquency, the highest rate since before the 2008 financial crisis. And delinquency rates have climbed to the highest level in almost a decade, according to Bloomberg. And here is why credit card debt is the most destructive force hitting American bank accounts this summer. Every dollar of credit card interest paid is a dollar that does not go into your savings account, your retirement account, or your emergency fund. At 22.76%, a $6,715 balance, which is the average American household credit card debt, generates approximately $1,528 in interest per year. That is $127 per month in interest alone that flows from your bank account to the bank's income statement. Your bank pays you $1 per year on your $10,000 savings. Your bank charges you $1,528 per year on your $6,715 credit card balance. That is the business model, and 29% of Americans have more credit card debt than emergency savings according to Bankrate. For those families, the net financial trajectory is sharply negative. The debt is growing faster than the savings. The interest is compounding against them. And every month that passes without paying the balance in full widens the gap between what they have and what they owe. And the pandemic excess savings of $2.1 trillion that were accumulated from stimulus payments and reduced spending during lockdowns have been completely depleted, according to the San Francisco Federal Reserve. The safety net that kept families afloat during the inflation crisis is gone, and the credit card has become the replacement. Not because families are irresponsible, because their income does not cover their expenses in an economy where consumer prices are 26% above 2019 levels, health insurance premiums have doubled, gas is at $5, electric bills are at record highs, and groceries cost more every month. The credit card is not a luxury. It is the last bridge between what a family earns and what it costs to survive. And the bridge is charging 22.76% toll. And the toll is consuming the wealth that the family was supposed to be building. And by the end of this summer, after the electric bills hit and the grocery prices surge and the gas stays at $5, millions of families will have added another $2,000 to $4,000 to their credit card balances. At 22%, that additional debt will cost them $440 to $880 per year in interest. Every year, compounding, until it is paid off, which at minimum payment rates takes 15 to 20 years. That is not a financial product. That is a wealth extraction machine, and it is operating inside your bank account right now. And the summer of 2026 will accelerate the extraction because every cost that forces families onto their credit cards is surging simultaneously. The electric bill that was $200 in July 2024 could be $350 to $450 in July 2026. The grocery bill that was $900 per month is heading toward $1,100 to $1,200 by fall. The gas that was $3 is over $5. The insurance premium that was $400 is $700, and every dollar of every increase that the family cannot cover from income goes on to the credit card at 22.76%. And the balance grows, and the interest compounds, and the minimum payment rises, and the amount available for savings, for retirement, for the emergency fund, for any form of wealth building shrinks with every billing cycle. And the New York Fed reported that credit card delinquency rates are climbing, meaning more Americans are not just carrying balances, but missing payments entirely. A missed payment triggers the penalty rate of 29.99%. A second missed payment damages the credit score, which raises the interest rate on every other form of borrowing. A third missed payment can lead to collections, lawsuits, wage garnishment, and bankruptcy. The escalation from a manageable balance to a financial catastrophe takes approximately 6 months of missed payments, and the summer cost surge is the event that will push millions of families from manageable to missed, from missed to late, from late to collections. And the banks that issue those credit cards will report the interest income as profit, while the families that generate it are destroyed by it. The FDIC deposit insurance limit has not changed in 16 years, and it no longer protects what it was designed to protect. The FDIC insures your bank deposits up to $250,000 per depositor per institution. That limit was set in 2010. It has not been adjusted since. And cumulative inflation since 2010 is over 40%, which means the real value of that $250,000 limit is approximately $178,000 in 2010 dollars. The protection has shrunk by over $70,000 in purchasing power without anyone changing the number. And for the retirees and older Americans who represent the core audience of this channel, the $250,000 limit is increasingly insufficient. A family that sold their home and has $400,000 in a bank account has $150,000 that is completely uninsured. If the bank fails, the FDIC guarantees the first $250,000, the other $150. Zuru is a claim against the failed bank's assets, which means it gets in line behind other creditors and may not be recovered in full. In the 2023 bank failures, the FDIC made the extraordinary decision to cover all deposits, including uninsured ones, at Silicon Valley Bank and Signature Bank. But that was a political decision, not a legal requirement. The FDIC is not obligated to cover uninsured deposits. It chose to do so because the alternative, letting uninsured depositors lose money at two major banks, would have triggered a nationwide bank run that could have destabilized the entire financial system. And the Senate Banking Committee has debated raising the $250,000 cap, but no legislation has been introduced. The limit sits unchanged at a level that was set when the iPhone 4 was the most advanced smartphone on the market and a gallon of gas cost $2.73. And the ABA Banking Journal noted that the unchanged cap heightens the risk of deposit runs during times of stress because sophisticated depositors move their uninsured balances first, creating a liquidity drain that can accelerate a bank's decline. That is exactly what happened at Silicon Valley Bank. Uninsured depositors who held 90% of the bank's total deposits withdrew $42 billion in a single day when they lost confidence, and the money did not go under a mattress. It went to J.P. Morgan Chase and Bank of America and the other too-big-to-fail institutions that depositors perceived as safer, which means every bank run at a regional bank strengthens the megabanks that are already too large and too powerful. The system is designed so that when a small bank fails, the big bank gets bigger, and your money is the mechanism by which that transfer occurs. And the people who understand this dynamic have already diversified their deposits across multiple institutions to ensure full FDIC coverage. And the people who have not are carrying concentration risk they do not know they have at institutions sitting on commercial real estate losses they have not yet recognized. And here is a fact that most Americans are completely unaware of. The FDIC Deposit Insurance Fund, which is the pool of money that pays depositors when banks fail, held approximately $128 billion at the end of 2025. That sounds like a lot until you realize that total insured deposits in the U.S. banking system exceed $10 trillion. The ratio of the fund to insured deposits is approximately 1.28%, which means for every $100 of insured deposits, the FDIC has $1.28 to cover losses. And in a scenario where multiple regional banks fail simultaneously because the CRE maturity wall forces loss recognition across the system, the demands on the fund could exhaust it rapidly. During the 2008 to 2013 period, the Deposit Insurance Fund went negative. The FDIC had to impose emergency assessments on surviving banks to rebuild it. Those assessments were passed through to depositors in the form of reduced yields and increased fees, which means a banking crisis costs you money even if your bank does not fail. You pay for the failures of other banks through assessments that reduce the return on your deposits and increase the fees on your accounts. The system socializes the losses and privatizes the profits. And nobody explains that to you when you open your account. The new Fed chair is about to make every one of these problems worse, and there is nothing you can do to stop it. Jerome Powell's term expired on May 15th. The president's nominee committed to aggressive rate cuts as a condition of the appointment, and by this summer, the new chair will have begun implementing the rate cut agenda that the president has demanded since before the 2024 election. And rate cuts will make every force I have described in this video worse for the average American with a bank account. Lower rates mean lower returns on savings accounts, CDs, and Treasury bills. The high-yield accounts paying 4% will drop to 3.5 or 3%. The retiree, depending on safe income from their savings, will earn less every month while their expenses continue rising. And lower rates do not lower the costs that are actually crushing households. They do not lower grocery prices, gas prices, insurance premiums, electric bills, or healthcare costs. Those costs are driven by supply disruptions, policy decisions, and structural changes that monetary policy cannot fix. And lower rates may actually increase inflation by stimulating borrowing and spending in an economy where the St. Louis Federal Reserve has warned that consumer inflation expectations may be becoming unmoored. And if inflation rises while rates fall, the purchasing power erosion on savings accounts accelerates. Your money loses value faster, and the gap between what your bank pays you and what inflation takes from you widens. And for the banks, lower rates create a different set of problems. Lower rates compress the net interest margin, which is the difference between what banks earn on loans and what they pay on deposits. When the margin compresses, bank profitability declines, which reduces the buffer that banks have to absorb losses on their commercial real estate portfolios. And lower rates make it harder for CRE borrowers to refinance at terms that make their properties viable, which means more loans hit the maturity wall, and more banks are forced to choose between extending impaired loans further or recognizing losses that reduce their capital. And the Fed, under political pressure to cut rates, is reducing the very tools that would give the banking system the resilience it needs to absorb the CRE losses that are arriving on schedule between now and 2027. That is the paradox of politically directed monetary policy. The rate cuts are supposed to help the economy, but they weaken the banking system that the economy depends on, and they reduce the returns on the savings that households depend on. And they fail to lower the costs that households are actually struggling with. The policy helps no one except the borrowers at the top who use cheap leverage to buy assets that appreciate while the savers at the bottom watch their purchasing power erode. What you need to do right now to protect your money before the summer forces converge. I have described 5 forces that are simultaneously hitting American bank accounts. Savings erosion from yields that are below inflation. The commercial real estate time bomb on bank balance sheets. Credit card debt compounding at 22.76%, the outdated FDIC insurance limit that has not kept pace with inflation, and a new Fed chair whose rate cuts will make the first 4 worse. And I want to close with what you can do about each one. First, move your savings to a high-yield account today, not next month. Today. The difference between 0.01% at Chase and 4% at an online bank is $399 per year on $10,000. The online account has the same FDIC insurance as the big bank account. The only difference is the lobby, and the lobby is not paying you $399 per year. Move the money. Second, if you have more than $250,000 in any single banking institution, you are carrying uninsured risk. Spread your deposits across multiple FDIC-insured institutions to ensure full coverage. This is not paranoia. This is what every financial advisor recommends and what every wealthy depositor already does. The FDIC limit has not changed since 2010 and is not likely to change before the next bank failure occurs. Protect yourself. Third, Attack your credit card debt with everything you have. Every dollar you pay toward a 22.76% balance earns you a guaranteed 22.76% return. There is no investment on earth that offers a guaranteed 22.76% return. Pay the minimum on everything else and throw every available dollar at the highest interest balance. This is the single most valuable financial action available to most Americans right now. Fourth, know your bank's exposure. You can look up your bank's commercial real estate concentration, its capital ratios, and its problem loan levels through the FDIC's Bank Find tool. If your bank has CRE exposure above 300% of equity, or if it appears on the FDIC problem bank list, consider whether your deposits are sufficiently protected and whether diversification to a second institution is prudent. Fifth, if you are a retiree or approaching retirement and you depend on interest income from safe assets, prepare for lower yields. The rate cuts coming from the new Fed chair will reduce the return on savings accounts, CDs, money market funds, and treasury bills. If you have not already, consult with a financial advisor about whether your income plan can sustain the lower yields that are coming and what adjustments might be needed to maintain your purchasing power. I want to close with a thought that I hope changes how you think about the money sitting in your bank account right now. Your bank is not a vault, it is a business, and your deposit is the raw material that fuels that business. The bank takes your money and uses it to generate profit through lending, through fees, through the spread between what it pays you and what it earns on your deposit. And the amount it pays you, 0.01%, is not determined by what your money is worth. It is determined by the lowest amount the bank can pay without losing you as a customer. And for decades, that amount has been effectively zero because most Americans do not know that a better option exists or do not trust themselves to move their money. And the bank is counting on that inertia. Every day you leave your savings at 0.01%, you are subsidizing a business model that generates over $100 billion in annual profit for the 4 largest banks in America. You are not a customer, you are a funding source, and the difference between a funding source and a customer is that a customer is served. A funding source is extracted from, and the extraction is happening right now, every day, through inflation erosion that your bank will not warn you about, through credit card interest rates that your bank will not voluntarily lower, through commercial real estate risks that your bank will not disclose to you, and through a deposit insurance system that has not been updated in 16 years and that your bank has no incentive to fix because the current system concentrates deposits in the largest institutions during times of stress, which is exactly what the largest institutions want. You are not powerless in this system, but you are uninformed, and that is by design. Because an informed depositor moves their money to a higher yield account, pays down their credit card, diversifies their deposits, and demands more from their bank. An uninformed depositor sits still, and a still depositor is a profitable depositor. Do not be still. Move, act, protect, because the summer that is coming will test every American bank account in the country. And the accounts that survive in the best condition will be the ones whose owners understood what was happening and responded before the forces arrived. Share this video with everyone you know who has money in a bank, which is everyone. Because the information in this video is the difference between a depositor who is protected and a depositor who is extracted from, and nobody deserves to be extracted from. Subscribe and turn on notifications. I am going to keep tracking bank health data, savings rates, CRE exposure, credit card trends, and FDIC developments in real time. No sponsorship from any bank, no financial product to sell, just the data about your money and who is profiting from it. Take care of yourselves out there. Protect your savings. Move your money where it is valued.